This is an Uncovered Japan company research report on Kaga Electronics, ticker 8154. Kaga sits between global component makers and electronics customers, sourcing parts, manufacturing products, and moving them through a worldwide network. In this video, we'll look at what that integrated model does, how the financials behave, and the key questions behind the valuation. Here is the fast snapshot. The report puts Kaga at a forward price-to-earnings ratio of 10.9 times, with fiscal 2026 return on equity of 17.8% and an ordinary margin of 4.1%. It also highlights a newly established 4% DOE floor in the shareholder return policy. This is not a pure software-style compounder. It is a cyclical electronics business where margin quality, capital allocation, and the demand cycle need to be read together. This picture captures Kaga's role. On one side are components such as chips and circuit boards. In the middle is electronics manufacturing, including its global EMS, or Electronics Manufacturing Services Network. And at the other end is distribution to customers. Kaga is not dependent on a single product. Its value comes from joining sourcing, manufacturing, and finished goods delivery into one service for electronics customers. Kaga's top line reached 658.9 billion yen in fiscal 2026. Over 5 years, revenue compounded at 7.4%, while operating profit reached 27.8 billion yen. The report emphasizes operating profit because net income can be affected by one-off items. For a company exposed to component cycles and spot market activity, separating core operating performance from the noisier bottom line is especially important. The segment mix tells us where scale comes from. Electronic components account for more than 86% of revenue, making the group sensitive to the global parts cycle. Smaller businesses, including software, contribute less revenue but carry higher margins. The integrated model helps Kaga earn more than a simple distributor. But the large components base also means that industry demand, memory pricing, and working capital movements can affect reported results. Kaga's advantage is not simply buying and reselling components. The report describes a full-line model that combines sourcing, contract manufacturing, and finished goods distribution, supported by a 21-site global EMS network. That can make the company a more embedded partner for customers managing complex supply chains. The same report is clear about the limits. Customer concentration exists, and Kaga does not have the same direct position with AI chip makers as some larger specialists. Cash flow is where the cycle becomes visible. In the normal years shown here, operating cash flow was roughly 25 to 31 billion yen. In fiscal 2026, it fell to negative 2.5 billion. The report attributes that swing to receivables linked to spot memory sales, rather than treating it as a permanent change in the business. That distinction needs to be tested in the next results, whether working capital normalizes and whether core cash conversion remains intact. Kaga's strategy sets out a path towards 700 to 800 billion yen of revenue by fiscal 2028, with a longer-term 1 trillion yen ambition. The plan depends on growing the EMS network and making further acquisitions, while the China Plus One supply chain shift provides a potential tailwind. The question is not whether the ambition is large, it is whether the company can compound EMS revenue, integrate acquisitions, and grow without relying too heavily on volatile spot memory demand. The risks are concrete. Strong AI memory spot sales supported fiscal 2026, but they also made earnings and cash flow more volatile. A broader electronic slowdown or inventory correction would pressure the largest segment. Kaga also needs to execute on EMS growth and acquisitions without diluting its operating discipline. And because the report sees the valuation as already reflecting some of the plan, the entry price and the durability of the cycle both deserve attention. On headline earnings, 10.9 times forward PE can look inexpensive, but context changes the reading. Kaga's 10-year average is about 7.9 times, and the report places the current multiple near the top of its own range. That does not settle valuation by itself, but it says the market is already assigning credit for better profitability, shareholder returns, and the growth plan. For this company, comparing the multiple with its own past matters as much as comparing it with other stocks. The report's scenario chart is a way to test assumptions, not investment advice. Its bear, base, and bull paths vary the electronic cycle, operating execution, and the multiple that the market is willing to apply. That is a useful discipline for Kaga, because even a well-run distributor can have uneven results in a changing component market. The operating indicators to watch are margin, cash conversion, EMS progress, and the mix of recurring versus spot-driven demand. To wrap up, Kaga Electronics combines independent component distribution, global EMS manufacturing, and finished goods delivery into a distinctive operating model. The report highlights its industry-leading margin, an updated shareholder return policy, and a strategy built around EMS growth. It also makes the trade-offs clear: cyclicality, cash flow swings, concentration, and a valuation that is high relative to the company's own history. For the full evidence and assumptions, Uncover Japan's deep dives take the analysis much further. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.